Hi, I'm Amir Ghandar, Reporting and Assurance Leader at Chartered Accountants Australia and New Zealand. I'm joined today by Anne Tarca, who joined the International Accounting Standards Board in 2017 from the University of Western Australia's Business School, where she was a Professor of Accounting as well as Head of Department of Accounting and Finance. Professor Tarca also has served as a member of the Australian Accounting Standards Board from 2014 to 2017 when she became the research director at the IASB. So really pleased to have you with us today, Anne. Thank you for joining.
It's a pleasure, Amir.
Now, what Anne has just delivered really quite a landmark address at the AFANS conference last week. What we thought would be good to sort of do a bit of a deep dive on is digital reporting, which of course is something that we've been very focused on at Chartered Accountants Australia, New Zealand. But clearly the IASB, the International Accounting Standards Board, and the IFRS Foundation have embraced digital reporting and extensible business reporting language, or the format. Can you tell us a little bit about why and what these things mean in your words and from the perspective of the International Board?
Thanks, Amir. Happy to do that. So the idea of digital reporting and XBRL are not new. The IFRS Foundation and the IASB have been working on the IFRS taxonomy for more than 15 years. So our objective has been to promote a taxonomy so that when a jurisdiction using IFRS standards chooses to mandate digital reporting, they have a taxonomy that's ready to go. So the IFRS taxonomy is the tagging that goes with the IFRS standards and enables the digital reporting. So IFRS Foundation, why do we support a taxonomy? Well, because we see some advantages in digital reporting. And so there are plenty of potential advantages that people can consider, ranging from speed, accuracy, accessibility, across top cost savings and efficiencies. So really it's about getting more and better data to support a richer data analysis. And in the case of public company financial reporting, better investment decisions.
Mm. And that, some other capital markets have, of course, already mandated digital reporting, whether in XBRL or otherwise. And it's been something that's one of those big advantages is the value to investors, and also that you've just sort of touched on there. How do you think investors and others in the capital markets see this? Do they want digital reporting?
Well, I think they definitely want digital data. They want the data to be electronic. They have a great incentive that it's in electronic form. So whether that comes to them through a commercial data provider, or it comes to them direct from a data repository like the SEC EDGAR repository in the US, I think that depends on their individual situation. So the drive for digital reporting could be different between investors. But so if we step back and say, do they want digital financial reporting? There are potential benefits for investors of digital financial reporting. We've been exploring quite a few of these over the last 1 to 2 years at the IFRS Foundation. And we've been thinking about things like more data being available because more companies would be covered. The coverage of databases is in some cases limited, so a wider universe could be covered. There could be more as reported data because the data providers standardize their data, so it could be more. There could be more as reported in the financial statements type data. Electronic reporting can have a role with textual data, providing more detail out of note disclosures. And there can be speed of access as well. So potentially there are lots of benefits there. But as investors think about this, we have to think about what the we have to think about how investors need their data So they need their data to be accurate. They need comparability in their data. They need a time series, and they need full coverage of the universe of companies that they're interested in. So all those factors have to be there as well before those benefits can be realised.
And I think in your address you referred to digital, in a reporting, in a comparison with photography, of course,
Yes,
which
yeah,
moved, with many big impacts, and I think
yes,
everyone would agree, quite a lot of
yes,
benefits
yes,
from film analog onto digital. But
yes, indeed.
one of the challenges, I guess, is that some preparers, not all, but some groups of preparers have raised what probably is quite a valid point, that there is a greater cost involved, I guess, in transitioning to digital reporting, and a concern around that cost as well as the challenges. What would you say to those sort of concerns?
Amir, I'm not surprised that people talk about the costs. That comes up with taxonomy, the same as it comes up with all the accounting standards. And from the position of a standard setter or a regulator, people have to think about costs in excess of benefits. So I'm not surprised that we hear from preparers having concern about the cost, but we know from the US experience, where the taxonomy has been in use more than 10 years, it's a startup cost, it's an initial cost. And people get their skills and systems in place, and the ongoing costs will then reduce and the benefits will increase. So there is learning in the beginning. There's learning on how to do it and ensure the accuracy that's so important. But once the learning takes place, that is the time that the benefits can come. So this becomes a technology like any other. We all have costs when we get going initially, but then the benefits can flow afterwards.
Yeah, and I think it does almost become a moot point if you think about, whether, or perhaps a boutique point if you think about going back to film-based photography. But is it the case that after that initial investment and learning, that the costs that in those markets that have mandated it, the US, for example, can you say based on research or the experience that the costs have actually decreased in later periods? Or
academic research in the area is really interesting, and they've been delving into what they think the benefits are. The research is not so good at capturing the costs, but the data we talk to we at the IASB and IFRS Foundation, we talk to consultants who've been involved in the tagging of the companies that are the foreign private issuers. So they've begun tagging with the IFRS taxonomy and lodging with the SEC. And so we've been talking to consultants, and so yes, there's a cost, but then things do get set up, and I would expect it's only early days for those entities because they've only just begun that process in the United States from the end of 2017. But I would expect those costs to reduce over time.
Mm-hmm. And why do you think it has taken so long for many countries to embrace digital? I mean, you have to admit it, here in Australia and New Zealand as well.
Well, it is about costs and benefits, and governments have a responsibility when they're making their economic decisions to think very closely about costs and benefits. But I think what is so interesting that we've seen many areas of government mandate the use of taxonomies and the use of digital reporting. So I am referring, of course, to the standardised business reporting in Australia that's been in place since 2010, 2011. So when the government can see the benefits, so if it's the tax office or it's APRA, both the government can see the benefit of getting the data into the electronic form and using software and tabulated reporting so things are clear, accurate, consistent, to get those benefits from a taxonomy. So we see forging ahead, not just in Australia, but many other countries have forged ahead with their government type reporting because they could see the benefits. And so yes, there would have been a cost imposed initially on those entities, but the government has pushed through because the benefits on the other side of so much more data, better data, more excessive, the efficiencies are boundless. So it's proceeded. But I think your question is referring to that we have been somewhat slow in terms of mandating it for our listed companies. But things change. We've got a lot more experience now of taxonomies. The software, the tools have been developing, particularly because the SEC has led in this area, and there's a good solid 10 years of experience. And when I hear people talk about the people who've been involved in the various capacities, when they talk about that US experience, they are saying it's paying dividends, that it's a positive thing. Now, the knowledge of that experience can then be taken to Australia and New Zealand, and that's something that we can start using. And indeed, there's plenty of internal experience as well if we think about APRA and financial institutions and insurance companies. So there's plenty of internal experience as well.
Yeah, I think that's one of the things that really attracts many members of Chartered Accountants Australia and New Zealand. Certainly, it's come into our priority areas for advocacy, simply because there are so many flow-on benefits of moving to a taxonomy, to a digital approach, as you can see in those government departments. And it does seem high time that the broader public and investors could benefit from that updated technology. One of the more extended benefits that I'd be really interested in your thoughts around is how this relates to non-financial reporting, whether that's the management commentary, which I know the IASB has been looking at, or even when you look at other forms of extended reporting like sustainability reports. Do you think that digital and taxonomies have a role in improving that reporting as well?
I do think they have a role. The IASB hears a lot about how important the information is that goes to accompany the financial statements. So that might be the information in a management commentary type report that you refer to, but there's also a lot of talk around the narratives that companies produce in terms of environmental, social, governance information. There's a huge demand for that information. But what we hear is that the way that's presented differs enormously between entities, and how do investors get enough of that information, and how do they compare it between entities? So this is an area where technology has a lot of scope. So in terms of management commentary, the financial numbers in the management commentary can be tagged with the existing IFRS taxonomy, and then the other text that surrounds the numbers can be dealt with using other technologies, other search tools and other analysis tools. So that can apply into the management commentary. It can apply into the notes, because there's a lot of narrative note disclosure in IFRS standards as well. And then, of course, that can be extended into people's environmental and social reporting, their sustainability reports and so forth. So this is a case where there's huge demand from the investors for that information. And I do think that technology's got a really, really interesting role that it can play in making the information that's embedded in those reports much more accessible for investors.
That does sum it up nicely. It's about better communication, and the accessibility is certainly what came out in the research that Professor Peter Wells did with us earlier in the year. Look, it's I would say for any of you out there watching this, I would certainly recommend very highly Tarca's speech, which I believe you can see, and we'll provide a link to that below, and also that paper that CANZ put out with Professor Wells earlier in the year. But I wondered if I could take just a little more of your time and ask about two of the really key projects coming up at the IASB that will impact on Chartered Accountants' work. The first one is around presentation in financial statements. Can you, of course, with a paper put out earlier in this year, and of course extended to a little later than initially, can you tell us a little bit about why the IASB has put that paper out, and how you would see the impacts and benefits of those proposals?
Yes, Amir, I'm happy to talk about the ED. So this is the General Presentation and Disclosures ED. It's out for comment now. We're looking for comments up until the 30th of September. Now, this is mainly about the statement of financial performance, and the aim is to improve how information is communicated. So we've been talking about communication and digital, and using digital to improve communication. This is really back to paper-based in the sense of it's about more subtotals on the face of the statement of profit and loss. But of course, once we have more subtotals, they'll be tagged, and then people can extract those, and they will have so much more comparable information than what they have now. So that's the real thrust behind this project, because we're developing some categories. We're going to have some required new subtotals. And as we develop those categories and the required subtotals, that means for the first time, IFRS users will be able to draw down those subtotals and compare them between entities. That just isn't possible at the moment. So this is a real game changer. We're really excited about it. We've responded to investors asking us to do this. And so the focus there is improving, as I say, mainly the changes relate to the statement of profit or loss, more subtotals to improve comparability. There are some other things in the proposals. They relate to disaggregation, better principles for disaggregation to get more granular data. Again, something that the investors have been asking for. And the third area that is also in the proposals relates to management performance measures. These are the measures that some people refer to as non-GAAP or alternative performance measures. These are disclosures of performance measures by management. And many companies do these. ASIC has guidance. So in Australia, there is guidance, but that's not true throughout the IFRS world. So as part of this project, we're putting in some requirements that will result in more disclosures. And we hope that MPMs will be used in more transparent and more disciplined ways as a result of these proposals.
Yeah, well, that did strike me as one of the really important things in the ED, is where you would ask for a reconciliation of those key management performance measures, which again could be what we call the underlying earnings or the cash earnings. Sometimes there's all sorts of words for it, which probably don't always belie a lot of discipline. So investors would actually find those in the notes to the financial statements with a reconciliation, and actually that means it's coming in to the bounds of the audit as well. So that's quite a big change, and certainly something that we have seen a big debate around for some years, even in Australia and New Zealand, where there's a fair bit of guidance already. But the second project is where it is, I believe it's a consultation paper, discussion paper around goodwill and impairment. And the way that that's addressed, which of course is another massive area of debate has been for many years, but particularly right now, it's topical to just about any discussion, whether it's on financial reporting or auditing and the approach that auditors take to estimates. And these are some of the, I guess, the trickiest parts of the financial statements. What are you considering? And I know that there might be some things, everything seems on the table still, but there are some pretty strong suggestions of what the IASB would see as practical. Could you just give us an outline of that?
Yes, Amir. So the Goodwill Project, the work is a discussion paper. So there are a lot of things on the table, and we're looking for comments by the 31st of December this year. It does come out of our work on IFRS 3, the business combination standard. So the post-implementation review led us to think more on particular issues. And one of the big issues was in relation to merger and acquisition activity. So we know that there's M&A activity is an incredibly important part of the capital market. There's a lot of it goes on, and there's a lot of money involved. And consequently, there are also very large goodwill balances on the balance sheet of some entities. And they were the two issues around which a lot of this project is focused. So as part of our work, we've had a lot of feedback And the feedback seems to be quite wide-ranging, though it does, as you say, it touches on some key issues. So firstly, this business of the information provided about subsequent performance on acquisitions. How do investors hold management to account? Do they have the information they need? And, you know, the board quite early on could see, as a result of this detailed work, that the impairment test is not the way that investors can hold management to account. The problem with the impairment test for many investors is described as too little, too late. From a preparer perspective, the impairment test has been criticised as costly and complex. And then the board just came to realise that this whole need to be able to evaluate management, the subsequent performance of their acquisitions and hold management to account, we weren't going to do that through an impairment test. So we began to look at the work in two areas, and one area is about the disclosures around mergers and acquisitions, the subsequent performance of those acquisitions. And then the other area of the work was more focused on the goodwill asset and the impairment test. So if I may, I'll just say a couple more things about each. So in terms of the merger and acquisition activity and the subsequent performance, the proposals suggest that the board thinks it would be really, really useful for investors if the disclosures are improved. So within the discussion paper, we've got proposals on how we think that can happen, what we think is realistic. It's about more disclosure of the information that the management actually uses to monitor the performance of the acquisitions. So that's the thrust of that one. On the other side, in terms of accounting for goodwill, and I think you alluded to the fact that this seems to be a perpetual issue. So on the one hand, are there ways to improve that impairment test? And there's a lot of information in the discussion paper, because the board and the staff have done an enormous amount of work on how can we improve the IAS 36 impairment test. We've narrowed it down to a few suggestions. There's specific suggestions of ways that we can simplify the test, and we're keen to get feedback from people. Will this help? If you're on the preparer side, how do you respond to these simplifications? If you're on the audit side, how does that work for you? And then, of course, we need to know what investors think as well. The other part of that is the question about amortization of goodwill, which is currently not required under the standards as they are. And so we have put that on the table as well. But really the board's view is there are no compelling arguments to bring back amortization. So if people have, what we're asking for from stakeholders is any new evidence that they can feed in. We know what the existing arguments are, and there are some people who will have very vehement arguments in one way or the other. We've listed them in the discussion paper. But what would really help us is if there's any new evidence that we should be considering, and we will consider any of the feedback that comes our way.
Thank you, Anne. And like many things in accounting, very reasonable and intelligent people can have very different reasonable views for a long time. So
yes,
thank you.
Yes, this is a hard one.
Yeah. You've given us a lot to think about, and Chartered Accountants will be doing a submission on both of those projects. So to those out there, I'd very much encourage you to connect to us with any views you have, and we will look forward to seeing how those projects develop, in addition to the moves toward digital reporting. So, Anne, thanks so much for joining us.
Thanks for the opportunity to talk to you today, Amir. I really appreciate it.